exactly 1 o'clock. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither BillStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on a mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right, now I got my water and I'm all set. Now the Wall Street Journal came up, so hang on a second. Let's get back to what I was looking at. For some reason, they went down for a bit. Okay, all good now. So what were we looking at? Oh, yeah, Europe. Europe closed up about 2.5%. Now, of course, using the 5% rule, we know that 2.5% is about as much as you're going to expect major indexes to move in a day. So they finished at the highs of the day. They're up 2.5%. That indicates we have further forward progress to go. In our charts on futures, looking at the hourly charts, hopefully. Oh, that's nice and slow, too. Great. All right, I have a theory that I'm going to take my Apple down and see what happens. Click that. Stop using that band. See if that helps. I don't know. What's going on today? Oh, there we go. All right, so very exciting looking. And obviously now it's interesting because if you look at it, what we just did was we flipped from the daily view, which does not look that impressive, to the hourly view, which looks incredibly impressive. So it all depends on how you look at it. But still, this was our goal, 1925 on the S&P. We talked about that this morning. That's a strong bounce line. Back to the Morning Post, and we were looking for 16,150 on the Dow, and it's mission accomplished there. We're looking at 1925 on the S&P. We're right at that line at this very moment, and we'll probably stay here into the Fed. 4,200 on the Nasdaq. Amazingly, we're almost there. We just about hit it. NYSE 9,500. I think we're crushing that. Yep, 95.40, and Russell 10.40. Well, not there yet, but the 10.10 on the Russell is a nice move up for the day. So on the whole, very, very impressive moves, and that's where we're at the moment. Let's see if we can pull it up on the charts here. Give you another look. What is this? No. It should already be running. Why are you doing that? Oh, the 64-bit version. There. That's why there's a whole different version of it now. All right. I'm happy about this. It seems to be having less interference with the rest of my system running the 64-bit Thinkorswim. Well, we'll see how it goes for the webinar. All right, so gold, silver, nothing too exciting there. The dollar up around the 97 line. Oil just under 31, okay, which is where it peaked out on the rumors in the first place the other day. We just stopped being long here. We were long, and we just took the money and ran here for with a $1 gain, which is $1,000 per contract. We have the Dow, we have the S&P, we have the NASDAQ, and we have the Russell, and they're all right in that range where we expect them to be into the Fed. It has plowed right through all their resistance and shot up. They're all above resistance, but that doesn't matter. The 5% rule doesn't care about these lines. The 5% rule is telling us this is where we were heading for. All right, but now that we're there, it's not a good idea to have an opinion, okay? We need to just watch and see what happens. All right, let's do a quick question. If there are, oh, there's a bunch already. Look at that. Who started it? Wayne. Where do you see gold retracing on the latest move up? I think 1,200 is going to hold for now, unless for some reason the Fed gives some kind of indication that's going to knock the dollar up, or if Draghi does something particularly to knock the euro down, which will also knock the, either way, unless the dollar goes quite a bit up past 97. If the dollar goes up to like 98.50-ish or something like that, it's going to put a lot of pressure on gold. But I think gold at the moment is good for 1,200. It's just a little bit of a pullback, and there's going to be a long grind up, because all this money they printed for the last 8 years isn't going back in the bottom, and gold is just starting to realize that. And that's going to be a pretty profound change in gold. I can get to the Wall Street Journal, no problem. Okay, that's interesting. I was having big problems. All right. Paul says, hi, oil. See if you talking about a run up to 50 over time. You do. I see a few talking about. No, I do. That's our bet. We have long bets on oil that are assuming 40, 45 in July. So I'm. And by the way, be careful, because I was talking to a Reuters guy earlier. He was interviewing me. And he's yammering, he's talking about the price of oil, and I'm like, I don't see that. But then I realized he's talking about Brent and not oil. So when you're listening to these guys on TV, especially if they're foreign guys from Europe and stuff, they might be talking about the Brent prices and not our prices. But for West Texas crude, for our oil, I'm seeing, we just talked about this in chat. Hang on. I have an excellent example for you. Okay. So Craig's asked, I made a statement earlier saying I don't think oil's going below 30 again. And he wants to know why I would say that and what changed, basically. And I said, look, nothing really changed. We're in the third quarter of oil being under $50 a barrel and under 40 since December. And I'm talking about, see this chart here? This is Brent, by the way. But interestingly enough, we're talking about Brent because this chart was priced in Brent. But you get the idea. In fact, let's make it less confusing by actually pulling up the West Texas chart. So like I said, you have to be careful about your numbers, because I was talking about West Texas, but then I pulled up a chart that was in Brent, so I put up a chart in Brent to talk, to give them an indication. They're only off by a couple of bucks usually, but you just have to be understanding what numbers you're looking at when you're doing these things. So anyway, because I'm having, here we go. Here's West Texas. Okay, and now we'll go daily. All right, so West Texas since August has basically been under $50, but it averaged about $50 from August to November. All right? Now, you have to think about your quarters. The quarter that was just reported by the oil companies was September, October, November. And so in September, October, November, the average is 50 plus 50 plus 45 is it's more than 47.50. It's like 48. Almost $49. It's $48.50 a barrel. So that's your average here. Is $48.50. What's the average since then? Well, it's let's call that $42.50 to be polite. Let's say 42, and then we'll call this probably 37. So it's 37 and 42 is oh, I'm sorry. No, my mistake. I was counting the wrong months. December is here. So December is a 42 month. So we have 42 plus 47.50 is 90 is $90, and then we have $50. So 90 plus 50 is 140 divided by 3, which is 50 less 3 is $47. So the average here for Q4 in starting October, November, and December is right about $47. October, November, December, your average is way up here. And you just saw all these oil companies reporting horrible, horrible numbers. that scares the crap out of the market. All right? So here we are starting quarter one, where the top of the range is 37, is $10 below that. So about 20% lower at the top of the range and falling further. So whatever numbers you just saw for oil companies just reported, it's going to be more than 20% worse on revenues for the ones that sell oil. Because they certainly aren't increasing production to make it up because nobody wants as much oil. So tremendous downturn in revenues that there's no possible way that in the next 6 weeks they're going to be able to make it up and come back to anywhere near 47. We'd have to be up at 60-something in March before we'd even consider being in the 40s again for this quarter. So your average went from $47 here in the last quarter, and now we're averaging probably here $32.50 or $33. That's a tremendous, tremendous drop in oil. So, what I was talking about with Craig is I was saying we're in the third quarter of oil being under 50, under 40 since December, and the Q4 earnings significantly worse in Q2. What? Wait. And now you see losses in Q4. Earnings are significantly worse in Q. I think I meant to say Q1. And how long do you think that can be sustained? Yeah, I didn't mean to say Q1. How long do you think that can be sustained? And now, what I'm saying is it's a grind down that's killing these companies. And here is a really useful chart that shows how much it costs on average. Don't forget this is on average. How much does it cost to produce oil in the Middle East? $27. Some of it costs more, but the average is $27. How much does it cost to do with the shelf in the Middle East? $41. Some of it costs $70 or $65. Some of it costs $10, but on the average $41. But that's to get 40 million barrels of oil. That's only half the world's oil needs. You get up to $50, and you've wiped out. You're basically breaking even in Russia, onshore or offshore. So you basically break even in Russia. So OPEC plus Russia can barely, and this is Brent, barely break even at $50. Okay, OPEC better so than Russia. But if you want, but in other words, they can produce all the oil they have, which is 30 million barrels a day from OPEC. That's about as much as they can put out, and it doesn't do enough. Even if every barrel they could produce would be 40 million if they went to ramp up their production to the complete max. That's about what they're saying could be produced in a day, 40 million barrels a day. But they're at 30 million, and they sure aren't going to ramp up their marginal. This is, for them, this is their marginal production, the stuff that costs more than 40. They don't want to ramp that up. The stuff that's under 40, 30 million barrels, is what they're selling right now. So then you've got Russia and everybody else. So Russia's happy to sell whatever they can for 50 or better than 50, but we're not better than 50 now. Killing Russia's economy. That only gets you part way. Then all the other oil in the world that's being produced, other than OPEC and Russia, comes in at substantially higher costs. And it's one thing when oil was $47 last quarter, and these guys are making money, not much, but making money. Russia's losing $3 a barrel, but you know what? I'd rather sell my, how many million barrels? I'd rather sell millions and millions of barrels and lose $10 a barrel. I'm sorry, lose $3 a barrel than not sell and have no cash flow and have no money, right? You still got to pay all the people who are there and so on and so forth. So for that, they're going to produce. But you start getting into these prices, and people are going to shut down production and just stop producing. I'm sorry, this is, rest of world. This isn't Russia, this is rest of world. It doesn't make sense for that many barrels for Russia. This is rest of world. All right, so you have this marginal barrel. We need 90 million barrels. That's how much we're using right now. Actually, probably like 92 million barrels. Some of this money is such a big loser, they can't continue at these prices. That's North American shale right there. That's the oil sands in Canada. These guys cannot continue to function at these prices. And you're already seeing the spillover, the deep waters. You're seeing it. It's like Transocean is in the dumper. See, because they can't, they're not going to keep renting these rigs from Transocean so they can pump oil and lose money. They're going to finish off the wells they already have, but they're not going to go and drill new ones so they can, lose more money. So there's a natural role that takes this production offline over time, but it doesn't happen in a quarter because everybody in the oil patch thinks it's always going to bounce back. They always think it's going to come back, it's going to come back. And the banks that lend the money are like, oh, it's a cycle, it'll come back, whatever. Everybody thinks that. I just did the TV thing last week, so I'm not going to go into it again. But it's not a cycle. It's a permanent depression in the price of oil. We're going to have a very hard time getting back over 50. As soon as you get back to 50, all these guys start producing like crazy, and it's just going to freeze out the rest. So we're going to have a hard time getting back over 50 until a significant amount of this production comes offline. And that's where we are now. And mostly because demand isn't coming back. The only way to adjust the price is to curtail supply. And we're so oversupplied right now, it's going to take a very long time to get it to come back in any significant way. Probably all year, you'll be lucky to see 50 in the summer, basically. That's the way it's going to be. We'll be lucky to get back to 50 in the summer, unless OPEC does a drastic cut. If OPEC can cut 10% somehow, then we can make it. But otherwise, we're not going to. Where are we? So that's oil. But yeah, I think 45.50 is a natural price for oil worldwide. Even in a depressed economy, I think 50.60 is where realistically it should be, given where we are as far as cost of production. But the thing for the oil companies is it's not a good investment because that's not very profitable for them. They're not going to come back to the glory days and start making $40 margins per barrel of oil anymore. It's just done. All right, so you have to be very, very careful where you invest in oil and what you invest in. It says, could you review how you determine the time frame over which to make the strong bounce levels? That's easy. You're generally looking for the strong bounces to happen over the same period as you fell. And so the worst, so here's the S&P. So we fell from the top here, here on the as far as the bounce goes, here's the violent fall, which took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, about 15 days, okay? So what you want to see is that in the next 15 days, you want to see a strong bounce from there. We didn't do that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. So call this about the same time period. All right? Or pattern-wise, actually what you want to see is you want to see these W. You want to see this W pattern? You want to see that kind of pattern forming. A bullish pattern is when you get a high higher than the middle of the W. And if you're doing an M, so you get these M patterns too. If you're doing the M, it's the same thing. You want to, if it's going to be bullish, it should hold that low. So you do this and you do that, and it's not an M. So a broken M, okay, a broken M is a bullish pattern. A broken W is a bearish pattern. We couldn't get back to form the full W. See how you only get back to about the middle of the W here, and then you break. That's a bad bearish pattern. Here, a bad pattern, well, there's two indications. First of all, not getting back to here is very bearish. So not getting back to 1942 within the same time period, so about that thickness here. All right, so roughly by here, if we don't get back to 1942, that's going to be a bearish sign. If we get back here in that amount of time and begin to fail, that's a bearish sign. But on the whole, the distance between here and here, which should be right about here, there's no way that's going to happen. So we can always say, we're not going to come out of this drop bullish. There's nothing going to be bullish in a long-term chart pattern. And I don't want to get all technical about the chart, because the point is, if you look at fatter and fatter candles, well, here, let's take a look. Just for an example here, let's look at the S&P. All right? So here's our same W that we were just looking at in the daily chart, right? But here's what I mean by the time and the pattern, because when you switch to weekly, all of a sudden that stuff becomes pretty insignificant, right? And it's just a blip. Now watch when you switch to monthly. This is when you really get it. Oh, that's all this is. So the point being that by reversing back and getting back to that middle of the W here, what we actually did is form a bullish, I think that's called a spinning top pattern. I wish I could blow it up more, but I guess I could. Wait, hang on. Yeah, 1, 2, 3, 4, 5. There you go. All right. Oh, now I can't. Ugh. There. Okay. So what are we doing? Oh yeah, this is monthly. So on the monthly chart, all that really happened is we tested this support, which is what, 1850 most likely, right? No, 1800. But we tested our support at 1850, which is right here actually, obviously this line. So right about here is our 1850 support, which is well tested down here. And as soon as we go below it, we zip right back up. And I know it doesn't feel like it to you, but you have to think about how it's going to look in the future on a monthly chart, and it's going to look nice and bullish like this does. See this plump over here? Yes, we went below. Yes, this was a horrific drop, but on the whole, we consolidated at that 1,000 line and then had a very, very bullish move after that. Very nice run, up to 1,000, actually up to 1,200, which is a 100% gain, right? So here you go from 6 to 12, 100% gain. We pull back 2,000 we pull back 200 of the 100% gain. So we went from 6 to 12 is 600 points, a little higher obviously, but 6 to 12, and then we pull back 1/3 of it, a nice healthy Fibonacci retracement of 1/3, and that consolidates at the bottom here, and then boom, off to the races. So the fact that we only pulled back 1/3 and consolidated and then took off again was very, very bullish. And here's what we're doing it again. We're consolidating down here, and then hopefully we'll form up a base around here, just like this does, form up a base, and then over the next 1, 2, 3, 4, 5, 6, 7, 8, 9, so basically by the end of the year, we'll be recovered back to about a bit over 2,000. So in 8 months, we can go back around this area, and we will then form a very nice bullish consolidation pattern. All right, so things look very, very different. When you think about the charts, you have to think in terms of how does this affect the long-term chart too, not just the short-term chart. Let's try one tweak. Let's go. Okay. So, everybody gets very hung up in these hourly charts. Look at the hourly chart. It doesn't mean anything. Daily chart barely means anything because these markets move in decade-long trends. On the fundamental side, I'm not talking about the TA side, but in fundamentals, you've got long-term trends that do hold up over time, and those are what matters. So the market has, in the last, since 2009, the markets have gotten much, much healthier, huge inflows of money and so on and so forth. The problem is what happens when the money stops? Is the Fed right, and are we ready to stand on our own and hold up around this level, or did they still need to be pumping money in to keep this thing going? The Fed's betting that they can remove their accommodations and that we can muddle through at this level, which for them is fixed. All right, this is fixed to them. Because in 2007, the S&P was here. They only wanted to fix the market. They didn't really plan on blowing it up. This is what Greenspan would be calling irrational exuberance. All the Fed did was try to fix the market. They sure as shit did their job. The market is fixed. It's beyond fixed. So at this point, the Fed's saying, hey, we're taking our money back now. Thank you. We lent you the money. You don't need it anymore. Give it back. That's what they're saying. And there's nothing wrong with that. It's actually a perfectly valid strategy that they're on. All right, where are we? Would you buy in cheap options or roll them SQQQ 28? I mean, I don't know why specifically the SQQ short 28 calls. Oh, are you talking about in the 5% in the option opportunity portfolio? We have, we have these 27 calls. So I'm not sure which ones you were talking about. We originally sold something else. I don't even remember what we sold anymore. But we rolled to these, the short June 27 calls, because I kept saying the stupid NASDAQ was not going to keep going down. As you know, I called a fundamental bottom last week and said, this is it. We're willing to take a stand here. So this had been a horrific loss for us. And in fact, the whole portfolio now is up 5%. Let's refresh that and see if it's still. Probably is. 7%. Look at what a day we're having. So the whole portfolio is now up 7%. It was down like 30-something% at one point. In fact, when we just reviewed it, it was down 12% last week, right? So it's gained 20% in a week because we got super aggressively bullish in this portfolio. And one of our super aggressively bullish plays, though, is this one. We sold $25,000 worth of these SQQ calls. So do I want to take it off the table? No, because I'm perfectly satisfied that the NASDAQ is not going down further. I think it was the sell-off was a bit overdone. So we're happy with our short play. What we have to worry about, though, is we did get nervous because we were getting huge amounts of pain, and we're going to have to pull this trade before we lose too much money. We had it for about $1.10, this SQQ. It was $1.10, and now it's still $1.10, so we didn't lose any money on it, but we don't need it. The SDS trade, I mean, I think just to be safe, we might keep this on. I have to think about that. And this SDS trade, of course, is kind of getting dead already because the S&P's up so much. I think what I would do right now, though, is buy these guys back for 20 cents because they're kind of worthless. And that will leave us with just the short marches, and that will protect us against a sudden downturn. So that's worth it. Rather than cashing these in for $1,200, I'd rather leave the $1,200 on the table as insurance and spend another $400 to buy back this guy. And then what we'll end up with, we'll have $1,700 worth of insurance in our portfolio to protect us from the SQQs, and then we can take off these SQQs because we don't need them, so we don't have to have a loss. I mean, we'll have a teeny tiny loss over here. See the difference between the two? So we'll have a teeny tiny loss there, and then we'll be much more bullish because we'll be just waiting for these guys to expire. If these guys expire worthless, that's another $11,500 we pick up, which puts the $1,700 we'd be spending on insurance into context. All right, especially when we're ahead now. Now we're up 6.9% already, so we're in great shape. And I bet BHI is doing well. That's another one we pushed the bets on, right? Here's BHI up $1.34. Here's Sotheby's. Everybody's up. Oh, Disney's way up, $3. IMAX put up a nice number. iRobot is still dead, stupid bastards. Even Lumber Liquidators is coming back. That's a weird one. The CEO just said he had leukemia today, and the stock jumped up. And if I was him, I wouldn't know how to feel about that. I think if I announced I had leukemia, I'd really rather see my stock price go down. That's just to know people care. I don't know. It's kind of weird, but supposedly it's a treatable kind of leukemia. I just get leukemia, I freak out, so I'm not sure what a treatable leukemia is. How likely is natural gas to reach $2.50 in the spring? Well, that's a heavy bet for us, so I would say very, very, very likely would be my bet. It all depends on whether LNG, the company, Cheniere Energy, gets their exports together. At the moment, we're playing the NG K5 and probably doing well right now. That's from last week. Trade, active trader. Oh, there they are. NGK6, sorry, NGK6. And they're up from the open $2,000 on 4 contracts. So they're up $500 per contract so far. But that's nothing because, these 4 contracts, if we hit 50, that's going to be am I right? Wait. I wish I could get this straight sometimes. Charts, flexible. Okay. So /NG. I'll make sure I get the right number here. Right, it's $100 per penny. So 40 cents is so 40 cents is it is right, yeah, 40 cents is $4,000. So if all goes well, this will make $16,000 at $2.50 if we hit it by May. Now, that's all big talk though, because realistically what happens is we've had trouble at $2.20 and we've been in and out of this trade a few times already, and we've been very happy to take the money and run at $2.20 because then we just wait for it to come back down again. Now, the danger is that we'll take the money and run at $2.20 and it won't come back down, but frankly, we got out at $2.20 last time over here. We waited patiently and got back in at $2.02 is where we just re-entered last week. And now, if it goes to $2.20 again, it's not a bad thing. It's still a very, very nice amount of money that we're going to make. So it's not, you don't have to get the whole 250. It's just I'm going to be thrilled to make, at this point, 14 more cents, which is $1,400 per contract, is another $6,000. So it's another $6,000, and we're going to have, what, $8,000 on this set. That's, why not, right? Then you take it off the table and you wait for a pullback. If it never pulls back, we'll find something else to trade. We have ideas every single day. Look at these Nikkeis. Remember we were doing the Nikkei last week, all the way up to 16.2 today. But you know what? That's also funny because the Nikkei, though, even though it's at 16.2 now, it was at 16.3. Well, it was at 16.2 here. All right, that's yesterday, and then it was at 16.3 or 350 on Friday. So you just keep, if you're better off, and here's the 15th, here's Sunday night, here's 16.2 again. So you could have gotten in and out, in and out, in and out, and made a lot more money than if you just held on to the thing, which is what we did. We kept getting in and out of it. So if you just held it from last week's webinar, first of all, get out. If you're still holding it from last week's webinar, which I forgot what day that was it the 9th? 10th? Let's see. When did the month change over? 11th? Was Friday the 11th? No, because the 14th was what? Sunday? 12th? 14th. Okay, so the 14th was Sunday. So the 12th, so it's the 11th that we had the webinar, right? Or the 10th. Maybe it's the 10th. Well, whatever. Anyway, it was way down here. It was way down there, and now it's way up here. But the point is, let's look on the longer-term chart for the Nikkei. All right, so we got in here. We had a bad start to the trade, although what we did was we, of course, averaged in on the way down. But our line started at 15.7. We went down to, what, 1,500 or something like that. And by doing that, we averaged around 15.4. Then we got back to 15.4. We got back out of the stuff that we had to add on, and we went back to a regular amount. Then we hit 16,000. Of course, we got out. We had a pullback to 15.8, decided to get back in. Then we get a run up here, back to 15.8 again, back in, back to 15.8 again, and back in. You make a lot more money doing that than if you just sit there and hope it just goes up again from where you are. See, think about what you're leaving on the table here. It's like from 15.7, let's say you didn't even double down or anything. From 15.7, you get to 16, that's 300 points, and you're hoping for 16.5, right, or whatever. So you got 300 points, then you have 400 points, but then you never quite get there, and you're waiting and waiting and waiting, and now you have a retrace. In our case, though, we're happy to take this money and run, even though it was only 300 points, especially because we doubled down and lowered our average. But either way, though, we're just thrilled after recovering that we should be happy that we made some money. Then we get back down. Now we're clean to get back in. Now we make some money again, get back out. Now it goes down again, and we get back in, make money, go back out, get money, and go back in and out again. Which we're out now. Now we're out. I want to be clear about that. We're out now. We're happy with this gain. We'll see what the Fed says. That goes for the indexes, too. At this point, we're just going to wait and see what the Fed does. I just said that to people in chat because it doesn't. Why should I have an opinion? I'll read what the Fed says. I'll see how the market reacts, and then we'll decide what to do. There's no pressure. I don't have to have a bet. It's funny because that's true with horse racing too. People go to the racetrack and there's like 10 races, and they bet on every race. And I'm not a horse racing guy, to care less, really. But sometimes, if you look at the sheets and you look at the numbers, you see, like, okay, here's a horse that has run much faster than the other horses on other tracks, and he's got a jockey who has more wins than most of the other jockeys, so he's a good horse. Now, every race, you don't see that. But sometimes you see a pretty obvious horse that should be winning. So you make a bet, and so people, this is always true. It's true in the track. It's true everywhere. It's true, especially true in poker. Oh my God, the less you bet, the more you can win because you avoid the bad bets. You should not be constantly betting. You should be waiting for very good setups that you have faith in. All right, so that's a very important point about making these bets in the futures for sure. Let's see. How likely for natural gas future? Okay, we just did that one. Oil. Do you therefore think XLE the long, medium term? No, I don't, because you're going to have in the XLE, you're going to have certain people who are going to go bust. Certain, they've got good and bad components. You want to just pick a couple of good companies like KMI, like Buffett just bought KMI. They're a pipeline company. His attitude is they went down with the energy patch, not as bad as most. Where's my thing? Oh, stock charts, okay. KMI. So they got beaten up with the energy patch, but they don't have wells. They're a pipeline company transporting the fuel. That hasn't changed. So Buffett's looking at that and saying that's a value. We've talked about that in chat before. That's a value because this is stupidly cheap for them. It's not like they're selling oil. The amount of oil being sold in the country is fairly consistent. It's just the price that's gone down. That's not their problem. A little bit is their problem. They have to, if they get more squeezed, they get squeezed by the people who are running the oil through their pipelines and stuff. But on the whole, it's not the same business, and that's the kind of stuff you look for. Look at the tankers right now. The tanker business is going to pick up again. You want to be, a lot of these pipeline plays are very good plays right now. They're going to have, the volume's going to be there. The business is going to be there. It's not going to change. It's just that as it comes back, they grow more in favor with people. What do we think about Deutsche Bank? I really think it's over worried. We like Deutsche Bank long at 15. I don't know where they are now because they change every minute. But at 15, I put my foot down and said, there's a value. Oh, here we are. Look. Okay. So they only hit it for a day. Last week when they hit 15, I was like, that's worth it. I'm like, at this point, it's just silly. They're either going to bankrupt or they're going to bounce back, and they are in the process of bouncing back. It's overdone. The EU is going to bail them out. They're not going to leave them hanging out to dry. But yes, we should worry because, especially if England leaves the EU and the euro falls apart and other things happen. With any bank is like that. But the thing about any banks is the whole system is based on trust. And there's a scene in It's a Wonderful Life with Jimmy Stewart, from the Great Depression, right? That's a movie from the Great Depression. And in that movie, there's a run on the bank. There used to be runs on banks all the time, especially in the Depression, though. But in the movie, Jimmy Stewart, the people are demanding their money back from his bank. And he's like, I don't have your money. And then people are freaking out. What do you mean you don't have my money? And he's like, no, because your money is in his home, and your money is in his farm, and your money is in his, he's naming the actual people in town. But that's what a bank does. That's their job. They take your money, and they then turn around and invest it. If they just kept it in the vault for you, it wouldn't be a bank, right? They're not fulfilling a function really in the community, are they? They just take your money and hold it in a big vault. All they're doing is protecting you from bank robbers, or from being robbed yourself at home. Sorry, they can still be robbed at the bank. That was a primary function of the banks back in the day, that everybody's paranoid they'd be robbed. But you don't really have money now. That's the thing. There's nothing to rob. You have a credit card. Someone can take your credit card, and you call the company and cancel it. So that function of a bank doesn't exist anymore, storing your money safely, which is why the whole thing is nonsense about, the way they treat electronic currency. But that's another lecture. But the point being that the bank takes your money, which is quote money, because there's no such thing as money anymore practically, and they distribute it out to all the people who want to borrow it, lending on your behalf technically, although obviously they don't pay you any interest because we're all getting screwed by the bank. But again, another story. So sticking to the main point though, ideally, that's what the point of a bank is. They lend out your money, they collect interest, they turn some of that interest over to you, and we all benefit as a community because your unused capital is being put to work out in the community. So any bank that you cause people to worry about, if you stir up enough trouble and get them nervous, you can cause the bank to default. If people start saying, "Oh, I don't trust you, I want to withdraw all my money," it's not there. They can't do it. They can't unwind it. They don't have the right to turn around to the people they loaned $300,000 to buy a house to, and say, oh, we need that money now because this guy wants to withdraw it. That doesn't happen. They can't do that. They've only got a certain percentage of the assets on file, and if you're not worried about the bank, it won't be a problem. If you do worry about the bank, and all of a sudden 10% of the people draw out their assets, the bank has no money. That's a liquidity trap. That's when they have a liquidity crisis. That's when they have to turn to the Fed or whoever, the ECB, and say, oh my God, you've got to give us $50 billion so that we can get through this weekend in case people withdraw more money. But either way, it doesn't mean the bank isn't viable even when they do that. But because of the scrutiny we have these days with the electronic, the whole internet basically lets you see what's going on in these banks. In the old days, you would have gotten a report at the end of the month and the crisis would be over by the time you got the report. Now you get the report minute by minute of the cash flow in and out of the bank, and people start scrutinizing it and worrying about it. And it's all nonsense, but it's self-feeding nonsense that can turn into something very real in a crisis. So that way, my answer is to say, I'm not worried, but if you do worry, then you should get worried because people are worried. That's the weird thing about money in general, is if you're worried about it, it loses its power. And that's very, very true for the banks. And Neil Kashkarian, who was the guy who oversaw the TARP thing and is now in the Fed, he wants to, he says the banks are too big and have to be dismantled because they can't save them. They're so big that they can't fix them if they do have problems. And because somebody can start a rumor like this on somebody as big as Deutsche Bank and cause them to have a crisis, that just makes them big, giant, vulnerable targets. And he's arguing that it's just not worth it. He's saying, hey, look, we're going to get right back in this whole situation where we have to bail everybody out again because they're giant targets, a big bank like this. And people are going to worry, and you can't stop it because the rumors are more powerful than the facts. And that's essentially how things are run now, which is great for us, though, because we can take advantage of things like a ridiculous, stupid sell-off in Deutsche Bank and sell puts or whatever. And you still can, by the way. It's still valid. I keep doing that. I got to get rid of that thing for swim. Now I know this one's working. If you go to Deutsche Bank, still has a lot of nervousness in it. You can sell the 2018 $13 puts for $2.75. That's net 10.25, and the bank's at 17 right now. That's like 40% off or something like that. So if you don't want to get, I had the same conversation with people back in when Bank of America was trading at $2 a share or whatever it was in Citibank. Look, people thought they were going to go bankrupt. I said, well, maybe they will go bankrupt, but you know what? If you wake up tomorrow and Citibank and Bank of America are bankrupt, then it really doesn't matter what you have in the market because it's all going to be gone anyway. The entire system would collapse, not just the money in the bank, not just your investment in Deutsche Bank or whatever. The entire monetary system of Europe will collapse if Deutsche Bank goes under. Not them in particular, but it's just, if that starts happening, those banks start failing. It doesn't matter that you think you have money in a brokerage account. And we found that out, by the way, because you couldn't withdraw money. People with E-Trade and things like that couldn't even get their money out and do anything with it. And the markets were crashing, the computers were turned off. You think your money's safe, but it's only safe because you believe it's safe. It's all based on trust. And once that trust is broken, if the system starts collapsing, good luck getting your money from your broker. They're going to turn around too and say, we don't actually have the money. It's invested here, it's invested there, it's put in there, you bid it into these stocks. They don't have it for you, and they also don't even have the certificates that you think they have. Those don't get transferred. But anyway, so the thing is, don't look behind the curtain. It's like those of us. Do not look behind the curtain. You will not like what you see. And you will lose all your faith in the system if you dig into this. I'm telling you, there's plenty of good books about this stuff that you don't want to read because it's just scary. The only reason the entire monetary system works is because of exactly what it says on the dollar bill, in God we trust. Because if you do not trust that that money is valid and tradable and a good means of exchange, then it's not. And we make fun of the Indians for trading, they wanted beads for the island of Manhattan or whatever. There's really no difference between beads and money. Okay, frankly, the Indians would probably say, what, you want these pieces of paper instead of perfectly good beads? That makes no sense. Beads you can make stuff with. What do you do with the paper except for burn it? Things are only worth something if everybody believes they're worth something. And everybody has to agree that they're worth something. That's why currencies fluctuate like crazy. Because if enough people tell you a euro is worthless, then you don't want euros anymore, and that makes the euro worthless if enough people do that. And unfortunately, in society today, the power of the media, the power of information media, that puts any rumor in, anybody who wants to start a rumor and get something going can push it out to millions and millions of people in 2 seconds, long before more rational voices can react to it. And a panic can be started in a second. My attitude about it with Deutsche Bank or something like that is saying, look, I never would have been interested in Deutsche Bank except now that they're half price. And when they're half price and I can then sell puts that give me a net entry another 40% below the half price, I don't mind. Because you know what? If they do drop down to 5 and my puts are seriously underwater and I've got a 10.25 net entry, I don't mind doubling down at 5 and having Deutsche Bank for 7. And maybe I'll be wrong, and maybe I'll end up with a bankrupt Deutsche Bank. But you know what? Again, like I said, at that point, if Deutsche Bank is bankrupt, I got bigger things to worry about than whatever I lost on Deutsche Bank. And we all do. So Paul says, Fed QE. Plus you can buy I forget what the bank ETF is. You can buy FAS. You can buy FAS and FAZ to cover. That also. In fact, we do that sometimes. So, in a real banking crisis, we can make really good money with the ETFs. Paul says, Fed and QE CD intervention, do you think we are fixed and can we do without QE? I think we, America, can do without QE, but the rest of the world's not as fixed as we are. We were way ahead with QE. And we put way, way more money into the system than anybody else, except for maybe China. And China's problem is the corruption in China, which is the same as Russia. It's an oligarchical system, except they hide it better. But all the money that the government pushed back in China went to all the top 1%ers in China who basically skimmed it off the top, and nothing really went towards fixing the system. All they did is juggle loans, increase loans, refinance loans, this and that. They didn't fix anything. We didn't fix much, but we fixed a little bit of stuff. And so, I think America is now back in a good position, and we're going to be the engine that drags the world out of recession, unless we get dragged down with them. But I think we can make it. But it's going to be a long, slow haul, and unless we get some serious infrastructure spending worldwide, I think it's going to take a long, long time to recover. We really need to put money into jobs and infrastructure globally. But it's hard to do, and it's especially hard to do because it's the whole refugee crisis threw a wrench into Europe's recovery. And they're all focused on that. They're not getting any other policy things done. It's a big mess over there. Asia is adjusting to China's slowdown. But China, the other thing about China's not slowing down. China is only now you only now realize that China was never growing as fast as you thought. And that means, of course, all the adjusted numbers, though, make it look like they're slowing down tremendously. They're not really slowing down tremendously. They were cooking their books, and now they're not cooking their books so much. So it looks like they slowed down, right? Like anybody, if you have a company that has an accounting scandal, and somebody goes in and audits their books, and they go, hey, you guys only did this, and you only did that, and then going forward, they don't get back to the robust growth they had. They suddenly go, oh, well, I guess we were never growing that fast, and now we're just sort of, pegging along. And that's what China's doing right now. They're just kind of moseying along at a 3 to 4% pace of growth, which is what they always were at, though. It's just there's so much pressure at every level from the top down in government to lie and exaggerate figures that it became endemic in the system. And when Xi came in, he's now started ferreting out the corruption, a lot like Obama did, by the way, because they blame Obama for having a huge deficit. But one of the reasons Obama has a huge deficit is because they had a $3 trillion war they were running off the books. So when Obama took office, he said, "No, you have to book the war as a cost. It's a cost. You can't say it's a one-time. You know, they treat it like a one-time expense, even though it was like an 8-year war. They're like, oh, it's a one-time expense, doesn't count." Obama's like, "No, we have to add that to the budget." And once he added the war to the budget, he got hit with a $3 trillion deficit. And and so you blame him for it, but it was really just being hidden previously. That's what happens in China. That's what's happening in China now. They're being hit with all these negatives that essentially have been going on for years. It's not new, and that's why I don't mind China though. That's one thing. So they need to be adjusted. When we're back to a realistic number, 2,700 on the Shanghai is a realistic number. It's a number that we had before everybody started believing all this idiocy about China. And now we're back to saying, okay, here's a nice country that's growing steadily, and here's where their market deserves to be. Although they still have a lot of problems because they have a lot of outstanding debt. I just wrote about that this week. They have a lot of outstanding debt. There's plenty of individual companies that deservedly are going to go out of business. They're going to go bankrupt, and it's going to hurt the banks in China. So they got a rough year ahead of them. They really do. It's going to be a tough adjustment. But they'll come out of it way stronger. Are you still in gold miners? Well, still in ABX. We're almost always in ABX. And yeah, we're still in it because that's a long-term position. We're not worried about that. OOP has USO, SCO not on the spreadsheet. Really? Wait, I'm pretty sure I fixed that. Let me see. UCO, here's UCO. UCO with USO. Oh, there's USO, right there. So here's a bull call spread on UCO, and here's the short USO puts. So yes, it is on the spreadsheet. I don't know when it got put in, but it's on there now. Would we be doing anything with it? No. I mean, I'm perfectly happy with that target. And why do people still invest in trustable yen? I did a whole discussion about that. I'm pretty sure I just talked about that on TV last week, right? Anyway, the thing about the yen is only 4% of the global currency. So people diversify into various currencies, and generally those currencies are euros, dollars, and yen. But when you're diversifying your portfolio, and Paul, I don't know, if you're a multi-millionaire, you can relate to this. Because you always sit there with financial advisors who tell you, we need to diversify you into euros and dollars and yen and whatever, maybe Swiss francs, but generally euro, dollars, yen. So nobody tells you, just take 4% and put it in yen, because that's how much they represent in the global economy. That doesn't happen. People put 10% in the yen, 20% in the yen. People in Asia put 50% of their money in the yen. That makes no sense because, proportionally it doesn't make sense. But if you live in Asia, why would you go buy dollars as your primary currency when you have nowhere to spend them? So people put their money into yen because it's a local currency. They feel good. They can take a quick trip and go to a Japanese bank and take out their money and so on and so forth. When you're really rich, you worry about all kinds of different stuff. And also by the way, it comes into play, like, where do I want to go on vacation? So why do you trust the yen? It's not about trust, though. It's about disproportionately investing in it. They might not like it, but it's the standard currency. And compared to what also? Compared to Korean won, compared to the Japanese won, compared to the Indian rupees and things like that. I mean, they're all horrible currencies. So if you're in Asia, that's your answer. If you're in Europe, you're certainly not going to put your money into anything but the yen if you're diversifying your portfolio. And same goes for America. I don't want to buy Chinese yuan. I don't want to buy renminbis. I don't want to buy rupees. What the hell am I going to do with any of those things? Yen, no, okay. All right. And again, when you're a rich guy, I'm like, yen. I don't mind stopping by Japan and doing some banking. I don't mind going to Tokyo for my banking. That's another thing. And also, and the capital flows. Don't forget, China's always messing around with the capital flows and restricting money in and out. You can't do that. Nobody's going to put $1 billion in your bank if you suddenly have currency controls on a regular basis, and then say, you can only take out this much or that much. That'd be the last time you go into those countries. No sound? Anyone else having that problem? Well, we wouldn't know, would we? Okay. All right, well, not much I can do about that. The Fed. Holy crap. 5 minutes. Okay. let's get ready for the Fed. So where are we? Oh, I cannot believe I do that every time. All right, here. I have to get rid of that because there's no way I'm going to remember. All right, this is working out great though so far, except for Diana. Gasoline. Ooh, we went long on gasoline this morning down here, and it went up to a high. I hope you guys got out. Holy crap! I didn't even see that. We called along at 98 this morning, and it pounded to 103. That's like a 5-cent move, and now it's back to $1. So I sincerely hope I wasn't paying any attention, but I hope you guys got out of that. Natural gas, like I said, I'm in that for the long haul, but the long haul means that 220. I'm going to be pretty happy to take some money off the table. Everybody's sort of calming down right about the lines that we predicted this morning, and we shall see what happens when the Fed says something. Now, again, we're behind Europe, but how much are we behind Europe? That's a good question. Short. Okay, so let's start with the all right, and let's go to a month, and let's compare DAX. Is that right for sure? No. Oh, GDAXI. Okay. There we go. The DAX and the FTSE. Right. Yep. There's DAX and the FTSE, and how about the Nikkei? Is that N225 on Yahoo? Wait, N22. Oh, I'm so good. N225. Holy cow! How does my brain do it? All right. So where are we? We are playing catch up to the FTSE. And the DAX is actually behind us. Ah, that's important. So on the whole, wait, where's the other one? What's missing here? The Nikkei doesn't show up here. Interesting. Okay. On the whole, in the last 5 days, the DAX and the FTSE here, which is the London, have moved up 3.7 and 6%. The S&P is only up 3%, so we're a bit behind the DAX. We're a lot behind the FTSE on a big recovery. On a monthly basis, though, we're actually not behind. London is doing very well. Boy, they love this exiting the euro thing. That's the London markets are thrilled to get out of that thing. That's what this excitement is about. They're all talking about getting out of the euro, and they're all happy about it. I don't think it's actually a good idea. Anyway. On a monthly chart, though, we're actually ahead of these other guys, so they were playing catch-up to us today. Don't forget, they had a big finish, but, and look at that. On a 3-month chart, holy crap. On a 3-month chart, the Nikkei is down 20% below us. That's why we like going along on the Nikkei, by the way. So the Nikkei is 20% below us. The DAX is 15% below us. Oh, I'm sorry, not below us. We're 8% down, so they're 6% below us net. The net is 6% below us here. So they're 6% below on the DAX. The Nikkei is 11% below us, basically. All right, so they're playing catch-up to us. We're not playing catch-up to them. And that means, though, that we probably are going to have a little bit of trouble getting over these strong bounce lines where we are right now. All right, so let's watch and learn and find out what our Fed people have to say. Let's do FOMC minutes. And there should be a thing here. And again, don't forget, it doesn't matter what we think. What matters is what John Hilsenrath tells us to think. So we'll find that out shortly also. Hang on a second. Here's live. Oh, by the way, though, if you have gains you want to lock them in, I would certainly advocate shorting here, especially on the S&P. Or the Dow, you see how here you can go 16, so it's 16,390, you could short and stop out above 16,4, so, or even 16,420, because it's not that much money, it's like 40 is a loss of $200. So you can short these contracts, and if we have a bad reaction, then you'll make your money and lock in the gains that you've gotten already today. Oh, so here's the minutes, hang on. That's how you lock in gains. Let me refresh this page and hopefully we can pull it up. And January 26th. No, that's not now. Minutes, not meetings. Shit. Sorry, something went wrong. Fed meetings and minutes. Oh, it's the 2015 minutes. Damn it. Stupid. There they are. No, wait. What's going on here? No, it should look like this, right? We had the January meeting, and the minute should be right here. They messed it up somehow. All right, let's go by what they say on TV then. Commodity slump can impact the economy. This ain't nothing. Say, commodity slump can impact the economy, more prolonged downside economic risks. It's nothing different than what they said in the statement. Jesus. So annoying when they do that. All right, we'll have to give it a few minutes to see what Hills and Mass says, but apparently nothing particularly exciting, and that means nothing particularly exciting happening here either in the indexes. So like I was saying though, since we had a fantastic day, since the OOP, for example, is up like 20% since I updated it like last week. So in a week it's up 20%. You want to lock that in. So if you want to lock that in ahead of something like this, you short one of the indexes in the futures, or you pick up like an index short like SDS or something like that if you don't have futures. But that locks in your gain. And if you don't, and don't forget, because the point is, if the Fed makes the market take off, then you're going to keep gaining value in the portfolio, and if you lose a few $100 on the futures or whatever, who cares? It's just insurance to make sure you lock in the gains that you already have. So that's a stance that you take before something like this. I didn't feel the need because I wasn't too worried about what the minutes were going to say. We talked about that this morning. But medium-term inflation forecast unchanged. It was very uninspiring. Oh, CNBC is useless. Spending and production data are disappointing. It's basically dovish. It's the same dovish thing that we were expecting. So now we'll see if there's enough gas in the tank to break that 1925 line, to break that 4200 line. Notice this is exactly what we predicted. 1925 is the number we predicted. 4200 is the number we predicted. 1025 on the Russell, so we're falling short. And I forgot what we had on the Dow. But this is that 5% rule. You got to take that seriously. 16.2 on the Dow. So the Dow is well over. But the Dow is the most useless index because it's it's only 30 components. So any one component can send it up. Plus also the Dow, because of Boeing, the Dow had that ridiculous sell-off that was, really unwarranted. Like everybody panicked on that one. So that was a good one to come back. The strong dollar's impact on inflation will fade, the Fed says. Well, what does that mean? That means that means they expect a weaker dollar. And hearing that from the Fed, that's a good reason to stay long on gold, long on silver. I can't believe how far silver came back. Silver was $16 like last week, and it's back to $15.35. Here's $15.20. I almost called a long here, but it still makes me nervous unless we're down at 15. At 15, I absolutely love silver long. 15.35, not so wild about it. Ooh, natural gas is moving up nicely. So That's a good one. So I don't have anything exciting to trade. I certainly don't want to go longer here, and we're already very long in our portfolio. So let's just take a look at our portfolios and see how they're doing after I check the questions. Oh, no, after we check Hills and Math first. Come on, boys. Give me a comment. Nothing? What to watch Fed minutes. Let's see. 5 things to watch for in the Fed minutes. That's not useful because we already have them. Wow, the journal is really sleeping on the job. All right, what do you guys find out? Let's see. Good time to buy some more natural gas. I like natural gas down here. I mean, I like it long term. I like it until it gets to 250. I certainly like the UNG spread that we have in our portfolio. So yeah, good time to buy it. Better time would have been when it was a little bit lower last week, but we like it. We got back in heavily on the futures last week, and like I said, it's already up a quick whatever the heck it is. Now it's $2,300. So you see, while we're talking about it, it's up another $500 from where we were. So that's fun. I mean, you can't complain about that, right? That's a good way to play. And meanwhile, we're just waiting and seeing how this gyration is doing. I'm really disappointed with the Fed minutes, though. What was I going to do? Oh, portfolios, right. Okay. So here, let's do another refresh, 6.9%, and now it's 7.4%. Boy, this thing's rocking and rolling. But this is what I kept telling you guys. In the options opportunity portfolio, we discussed this. This thing has incredible potential. What we did is we plowed in the original profits we made. We took a lot of positions, and the positions we have now are still showing a negative $22,000 balance. So we're now up $7,000. We have a negative $22,000 in positions. All these positions have to do is come out even or better, and we'll be at 139. All right, and this is not even 6 months into the portfolio. We're talking about being up like 30, 40%. All right, so what we did is we made money quickly. We then took that money and we invested it in bigger, longer-term positions so that we can make some really big money over the course of the year. It did not go our way at first, and we were down quite a bit. We were down like 30-something%, but we stuck with it. We did exactly what we're supposed to do. We stuck with it. We added to positions that were doing badly that we still had faith in. We cut a couple of positions. And now we're sitting here with what I consider a very, very good bunch of positions. In fact, I tried to cut something last week, and I couldn't find anything I didn't want, except iRobot, unfortunately. We screwed up on iRobot. I wish I would have cut that, but we didn't. So we're stuck with the position as it is now. I don't even know if they'll get back to 35 for that, but we'll make our adjustments. I'm not worried. But we have a very, very strong portfolio here, and especially when you consider we're still getting an $11,500 charge just from this SQQQ play. And meanwhile, though, it has to be, we sold short calls, so unless it's over 27, it's a negative on the NASDAQ. Unless it's over 27 in June, we get 100% gain on this. We get that whole 11,500 between now and June. It's at 23 now. They got to go up quite a bit to get back to where they were. In fact, frankly, I know we rolled off of something in March. If we hadn't rolled, we almost would have had it to expire in March. But but caution won out. The fact is, it was pressing our limits last week, and it was safer to do the roll just in case things got worse. Okay, I don't advocate sticking with bad positions. I advocate trying to fix bad positions, because that's all it is. It's a very different, since we're following this be the house strategy and we try to sell premium to others, right? Our whole goal is to just have all these positions we sell expire worthless so we keep the money. While the position's in progress, they'll swing wildly up and down and this and that. And also, because we're betting against each other, it's almost impossible for us, because we're hedging, so we're always betting against ourselves, even within the same position. So in other words, when we've got a long call on ADX and a short call on ADX and a short put on ADX, it's not possible for them all to win. All we're looking for is the net. So we are plus 96, minus 79, plus 725. is what? Is 90, 10.5 minus 7.98. So we're about $2,500, $2,600 on the position. You're going to have some horrific losses. Look, it's down 415%, but we don't care. We don't care at all. We bought the whole position. And in a greater standpoint, we bought the whole portfolio, and it's the whole portfolio that has to balance, not just any individual position. So some positions are there to do good in a certain kind of market. Some positions are there to do good in another kind of market. And if we're lucky, and boy, we've been so lucky in the short-term portfolio. I'll get to that next. But if we're lucky, then we have good timing, and we make a few good moves that like, we do. Now, a good move, by the way, was what we did was we called the top on SQ2Q when the NASDAQ spiked down, but we were too early. It was still a good call, but we were too early, and we had further pain in that position. But we cashed out the winning half of this trade, and this is the losing half of the trade. So we left that on. So this minus 11,500 that we've got here was the losing part of a trade where we already cashed out a huge winner on the long SQ2Qs. We pulled the trade apart, just like this one. See the 23s? Well, the net of this spread is $1.10, right, or $1.13. But now we could cash these guys. This is what we did with this one. We can cash this one for $2.08, which is more than we paid for the spread, and leave the naked short March 28 calls. In fact, I always want to do that, except we already did that with this. If we didn't already have the June ones, I would want to do that here, because I certainly don't think we're going to be back over 28 in March. But it's not worth it for us to expose ourselves to that much risk just to make an extra couple of bucks. So we're not going to do it here. We're going to just cash out that trade. All right, next is going to be the short-term portfolio. We'll take a look at that. And, wow, look at that go. 362%. That's like embarrassing. 362% is like way too much money. It's not supposed to do this. The short-term portfolio protects the long-term portfolio. The short-term portfolio is $100,000. The long-term portfolio is 5 times the short-term portfolio, $500,000. And the primary function of the short-term portfolio is to protect the long-term portfolio, so that we jump short. We get very short when we feel the market's going down. We generally try to hedge. Most of the positions we pick up generally tend to be short, but it's still where we do our playing, and we still do bargain hunting here. And we've just had such an incredible series of good calls in this portfolio that it's gone through the roof. Here's FAST, which we're stuck long on. I remember we were talking about FAST. We had a big spread on this, and again, this is a leftover spread. We have a $33,000 loss on this position, but the pieces we dismantled are cash in the bank for us, already profit. This thing still has until 2017 to come back. So if all goes well in the financial sector, we could actually make back that whole $33,000 between now and then. It's just a leftover position. It doesn't matter to us if it wins or loses. That's a remnant. We have a lot of those, and it's because we sell this incredible amount of premium. All right, this is a long call that was left over. We already took off the short calls. We've got these short calls. Same thing here with the SQ2Q. We have the same issue here. We sold 50 of those and we left them naked because again we just decided it was enough. TZA, I don't even know. I think I talked about why do we even have that position anymore? We don't want it. Apple, we sold those puts. CMG, we took a very aggressive spread on CMG. We started with a not very aggressive spread in March. CMG went completely the wrong way. And so we got much more aggressive on the 6. So technically, this position, see 1616 and 16, that's what we added. And it's a very, very aggressive position. This position, in fact, pays $110,000 if all goes well. And so far, it's worth $55,000. See the net? So it's worth $55,000. It can pay a double from where it is now. If CMG goes back to 560 and it's at 510 now. So if CMG goes up 10%, this spread will gain 100%. That's our bet. So we're pretty happy with it. Now, the nice thing about it is we didn't pay 50-something thousand for it. We only paid $36,000. So we paid $36,000 plus we also, and we didn't pay that because we actually sold these guys for $23,000. So we paid like $13,000 for $110,000 spread. So we're thrilled, and it's already way ahead. So that's been a big, big gainer. So that's what I mean by the short-term portfolio. Although generally we try to hedge, and here's another hedge, in fact, we generally try to hedge to protect our long-term portfolio. Also, then when something weird happens, like Chipotle has an Ebola, has an E. coli scare, and we don't think it's such a big deal, we take advantage, especially when we have this much cash in our portfolio. We can afford to take advantage of a situation like that. So we took a heavy bet. We took a stab at it here. This was not a heavy bet. This bet was how much? $15,000. So we took a $15,000 gamble here. It didn't work at all. And that was on 12/21. A couple of weeks later, though, Chipotle was so far down, we said, screw that. We're gonna make a much bigger bet now on this. So I don't think we're going to get back to 530 in March, though we do have about 30 more days. So we might, we could luck out. But even if we don't, though, this isn't the position we care about right now. We care about the bigger position, which is $110,000. All right, IMAX, that's dead. It's down $4,000 bucks. It's not terrible, but the IMAX play we thought would do well because of Star Wars and such. It got terrifically beaten up. I don't have a long-term issue with it, but I think that we're going to have a lot of trouble getting that March deadline. And silver, of course, silver is 100% in the money. That's a nice trade also. So as you can see, it's just like we keep taking these trades that work for the most part. So in addition to our normal hedging, that's where we end up with this. Now, here's the coolest thing, though. We're up to $462,000 here, but the long-term portfolio started on the exact same day on 11/26 with $500,000. That, because of this crazy rally, is now up 43%, and that is $716,000. So we're up past $1.1 million. We're up almost $1.2 million now, which is 20% more than we were in the winter. And it's funny because we did our portfolio reviews in Phil Stock World. Let's take a look. Here's our portfolio reviews, and you'll see, I think probably you'll see 3 times I have Dr. Evil. Oh, why is the picture not showing up? Oh, well. There was a picture of Dr. Evil here, but here. It was $1 million in December. It was $1.1 million here. Okay, so in December, it was 1004. In October, it was 1.1 million. I think that's where we started. Yeah, so October, October and November and December, we were hovering around that 1 to 1.1 million. Today we just blew through it. All right, so it's been a huge change. Back here. All right, so you can say, so now 716 plus the short-term portfolio is what, 460? Yeah, 462. So 716 plus 462 is 716 plus 462 is just about $1.2 million. So that minus the original $600,000, whoops, is almost a double. Oh, duh. Boy, did I forget how to do math today. So yes, 1.2 million is a double from 600,000. So 2 years we were up 100% on our 2 portfolios. And the point being, though, that we rode out this whole up and down the S&P, because don't forget, we wanted to go to cash, or I wanted to go to cash. I wanted to just cash in all the portfolios. The members wanted to go through this exercise of balancing the portfolios against the risky market. So in other words, rather than cashing everything out, which I wanted to do back here, and back here in the fall, I wanted to just cash everything out. We had a whole big discussion about it. And the members said we would rather see how you hedge and how you manage the portfolio through the downturn that we were expecting. So instead what we did is we kept making these adjustments throughout to adjust the portfolio. And we held steady. And like I said, we were at $1 million here. We were at $1 million. I think we were $1.1 million in October when I wanted to cash out. We went down to $1 million. And then we were hovering around $1 million all the way through here into January. And we just hit, even as weird as it seems, even on this downturn though, we actually gained 10%. And now we are ready to rock and roll. If this thing keeps going up, we will be moving towards $1.5 million if the S&P goes back to 2,100. I don't think it will, but if it does, that's where we are, because right now we're extremely bullish. We've pressed a lot of our positions very heavily, and we stand to do incredibly well on that. And again, though, the reason we hold up and the reason we have the strength is we're balanced always, but within being balanced, we're being the house. We're selling puts, we're selling calls, we sell both sides to everybody, so we don't really care what the market does. We know we're going to collect that premium that we're selling. And that's really the key to our success in these portfolios. And in the last one is the butterfly portfolio. And that should be doing, oh, look at that, holy crap. That's a huge move. The butterfly portfolio doesn't usually move that much. It's up like more than 10% from last month. That's a big month. And now it's up 100%, but that one's been going longer. This is a much slower moving portfolio usually, not today, but usually. Part of it is because the VIX is dropping. It's making all the stuff we sold a good deal for us. Part of it is also because we pulled apart some of these positions and got very bullish. Like here's a very bullish position on gold. Here's a bullish position on Apple. Here's a bullish position on Disney. We used to be agnostic, but now we're just bullish because it went down so far. We said, screw that, we're going to go long. So, you know, in some extent, the goal in the butterfly portfolio, we set up neutral positions that we collect monthly incomes on, but when something, you know, so we're hedged very well. So we make money as the thing goes down. So the Disney goes down and down and down and down. Even though it's going down, because we're selling puts and calls, we're still making money every month, right? Then it gets to a certain point where it's so stupidly low, like it was last month. It's so stupidly low that I said, screw this, I cannot in good conscience sell calls anymore on Disney. That was what I said last month. I said, it's too low for me to sell a call. And so we end up being long on Disney because we just decided not to sell calls anymore. It's a simple decision. Same thing went for Apple also. Apple got so stupidly low that we end up being bullish. There's nothing wrong with that. You don't have to stick with a strategy in a portfolio. You know what the problem is, though? If I was a hedge fund, I would have to stick with that strategy. If you're a hedge fund, you have to basically stick to the strategy you say you're going to follow. But by running a portfolio, you shouldn't be a slave to a strategy. So although generally our strategy in this portfolio is to sell calls and get a steady monthly income, in this particular case, and this portfolio is the steadiest portfolio we've ever run in PSW, not just the 2013 edition that we're in now. We've been running this thing for like mostly on for, you know, since 2007, and almost every single year this thing returns some kind of positive balance, even in the crash. And generally it's good for like something in the neighborhood of like 30%. That's you know what we pretty much are shooting for every year. It's incredible how steady this thing is as far as producing an income. But again, it goes because we have a diversified bunch of positions. Look what we have here. We have Valero, we have Walmart, we have Texas Instrument, we have Apple, we have Disney, we have gold, we have LNC, I forget which one they are. We have OIH, which is the oil thing. We're bullish on OIH, on the oil sector, on the energy spider. Not spider, it's mostly drillers and energy services. Procter & Gamble. Natural gas, we got super bullish on, nothing short. Valero again, and more Walmart. So we have a lot of Valero and Walmart pieces because of the way that trade worked out. So it's not that many actual positions. It's only like about 10, 11 positions. But there's a lot of different legs to the positions. And in this case, what happened is last week or last month when we adjusted it last, we ended up very, very bullish because we felt we had a good bottom to work off of. And now we're reaping the rewards for making that guess. Now, we could have been wrong. It could have gone the other way. It's not foolproof, but it just so happens in this particular case, it's going our way, and we're doing very well. All right, so I'm happy about this, but I got to tell you, we get runs like this when I don't think it's really warranted, and I really get back to that feeling where it itches me not to cash out. I don't like having 100% gain in two portfolios and not three. There's 100% gain here now. We have 100% gain in the long-term, short-term portfolios now, and the only one that's not doing as well so far is the options opportunity portfolio. But you know what? It's the youngest one. It's only started in August. It's only 5 months old. Give it a chance. These guys didn't start off this way. It's how they grow, because we stick with the positions, and over time they really accelerate. And that's one of the key. In fact, that's the reason we used to cash out the long-term and short-term portfolios every year. And I realized I wasn't getting the lesson across, especially in the long-term portfolio, of how this thing accumulates over time and becomes more and more powerful as an earning machine. As these positions get older and older, they get safer and safer, and you have a lower and lower cost basis, and you can do more and more stuff with them to sell. And here we have 27 short puts, and we also have 20 actual positions. So it's a lot of stuff, but it's all stuff it's so safe we don't even touch it. In fact, I just today was looking, and I said, we don't have any February anythings. This is a very low-touch portfolio considering how well it does. About 20% a year or so. It's a very low-touch portfolio, but it's the kind of stuff you want to put your long-term, safer money into. I certainly don't recommend putting all your money in the short-term portfolio. We put 1/5 of our money in the short-term portfolio. It's only an accident that it tripled, or quadrupled on us. We don't mean to have that much money in the short-term portfolio, but also because the long-term portfolio has been doing so well, we haven't had the need to transfer any money into it. So we're just accumulating a ton of cash. All right, and hopefully we'll find some nice things to pick up with that cash. But we don't need to, because like I said, you look at the numbers on these portfolios, and they've still got hundreds of thousands left to gain. The open positions in the long-term portfolio are minus $200,000. So that means that if all goes well and the market does well, we're going to pick up that $200,000. That's another 20%, not more than 20%, like 25%, 30%. It's almost 30% of the portfolio. That's if we do nothing and the market goes up, we'll make 30% more. Because we got really, really bullish at the bottom. And you see all these short calls. This is where it's killing us. Negative 100, negative 65, negative 82, negative 41, negative 171. These are all the ones that we've pressed and kept on and moved. And if these stocks start recovering, like look at USO. In 2017, we have a $15 put. Now, oil has to double for that to happen. If oil is $60 at the end of the year, we're going to make $11,000 back. So I don't care about this loss isn't important to us. We haven't even I think we might have pressed this bet, but this loss isn't important to us. We just want it to expire worthless in the end. We don't worry about the short-term numbers. We worry about the long-term goals. So I think it's a little unrealistic to hit 60 at the end of the year, but we're just going to roll to 2018 when it comes along, and then hopefully those will expire worthless, and we'll have that money to look forward to in 2018 then. It's a long-term portfolio. We're not in a hurry. We're happy to play the long game. The problem is, unfortunately, every time we get new people, most traders are not. Most traders take a lot of training before they can get that long-term view. That's the hardest thing I have to teach people is how to be patient and wait. So these positions, they work consistently, and they work great, but they take time. And in between that time, they might not work, and they might look bad. Like the options opportunity portfolio, we had a bad month or two, came right back. Right back, zooming back. But you got to be able to go through those downturns. That's the hardest part to learn. All right, got to wrap this up, get back to work. Good time to buy some more natural gas. We talked about that. SDF, like I said, we're not ready to kill that yet because I want to see how the Fed gets interpreted. We're not breaking over our strong bounces. That's not a good sign. So we'll see what happens here. Help, what's a short call? Short call is where you sell a call, but you don't have it covered. So you're just selling a call. In other words, I'm selling calls. If I sell, I don't know what Disney's at now. Let's say Disney's at 100. If I sell the March 110 calls, that's a short call. I'm selling the March calls because I'm betting Disney won't be over 110 in March. The guy buying the March 110 call is betting it will be over 110 call. He's long on the call. I'm short on the call. That's all. Not that complicated. TLT at strike. Whoa, what? We moved that. Uh-oh. Our current TLT position is we killed the March one, or I think did we kill the March one? I probably still have it. Okay. Oh no, we killed it. No, wait, March 1, 22. Nope, sorry, we still have it. We left the March one because it was so dead there was no point, so we're just sort of hoping it comes back. But we added instead the June 135, 128 put, and that is now in the money. That's like way in the money. So that was $4. We added that put. It's got a $7 spread, so hopefully we can make $3 there, which is more than the 157 we're losing in March. Assuming we lose it, though, of course, TLT can come down considerably from where it is. If you look at TLT, look how hard they come down. So we still have all the way, this is only February, we still have another this far for this thing to fall. So it could fall all the way back to the 122 area and put us back in the money. Okay, I'm not really counting on that. I'll be very, very happy. If I can pull $1 off the table on that trade right now, I'll be thrilled. So that's like half our money back, and then we have the other spread that's more aggressive that'll pay us off. So we didn't do anything with the put as the answer. We just left it there because it was dead, and we're hoping a miracle occurred. What's the UNG trade of the year? Okay, honestly, here. It's January 5 call, selling the January 10 call, so that's a bull call spread, and we sold the $10 puts. And at the moment, all these are showing loss, so you can still get in this trade for the same money we did. See, they can't possibly all be losing because they don't all play the same direction. Yet we're showing a loss on all three sections. So we bought the January 5 calls for $2.97. We sold the 10 calls for 70 cents, and we sold the 10 puts for $3.58. So obviously our target is aggressive. We're looking for that. It's 2018 play. We're looking for it to be over 10, which is like almost a 50% gain from where we are now. Article, January saw increase on, oh, thank you, Tom, appreciate it. Can I copy that? Yes, I can. Very nice, thank you, Tom. John Hilsenrath says, Federal Reserve struggle with uncertainty. Inflation outlook, the economy might alter their plans. Okay, see, here you go, that's bullish as hell. Oh, weather rising risks to the economy might alter their plans. That's so in other words, that's dovish, but not dovish enough because it's an iffy thing. Declining stocks and oil prices, doubts about China, indications of inflation expectations, other factors split into two camps. Those who believe the risks of the economy are materializing, and those who wait and see. Participants judge the overall implication of these developments for the outlook of domestic activity is unclear, so they're muddling. They don't know what's going on. The Fed said at the policy meeting, the Fed in January held its benchmark. That's just housekeeping stuff. Policy statement striking because officials decided not to make an official judgment of what they call the risk. In other words, so very, very neutral, this statement is what he's saying. The balance of risk matters because the indication of whether they're inclined to raise rates again or hold it or cut. Most participants view there's not enough evidence to dictate the balance. Indeed, the minute showed off staff comments of risk that economic growth and inflation will underperform. The markets can quickly reverse. The Fed will have a chance to look at more data. Expected inflation is an important wild card. We know that. Further declines of inflation, investors, households, low blood pressure. Further declines in inflation expectations indicate investors and households might be losing confidence in the bank's ability to move inflation to target. Undershooting it is an indication the economy's lack of vitality, like low blood pressure in a hospital patient. A number of participants indicated in light of recent developments they viewed the outlook for inflation as somewhat more uncertain or saw the risk as being to the downside. The minute said several participants reiterated the importance of monitoring inflation. The Fed used the word uncertain or uncertainty 14 times. That's a good point in the minutes. It used the phrase downside risk 5 times, downside 7 times. So Hilsenrath is not interpreting the Fed. That's why we're not going anywhere, because he's not saying anything. It certainly isn't more dovish, but basically what I see in that is that there's no way in hell that they are going to that they're going to raise rates. That's what it's saying. There's no chance between now and the next meeting in March that they're going to raise rates. In the March meeting, if everything is much better, they might talk about doing it in June. So there's no way this year we're going to get more than maybe 2 rate hikes. So that's where we're at. It's way lower. Most people are expecting a much, much more aggressive Fed stance than this. So on the whole, it's bullish for the markets, but that bullishness is already baked in on the rally we've had. Everybody expected this, and so we're kind of going to take a little stutter step here, and probably we have to consolidate here before we're going to break out. And look where we are, exactly on the lines we predicted. I mean, 2 weeks ago we knew this was going to happen. 4,200 on the NASDAQ, 1925, and to the penny. All right, you know you have a good system when you can make a call like that, and on the day of the Fed announcement, you're at that exact spot to the penny. Those were our bounce lines. All right, thank you so much, Tom. That was very helpful. I appreciate that. Pat, SDS and TLT question is in the OOP portfolio, right? So we did that. What do we do with TLT put? Nothing. We pray that it comes back, and if it doesn't come back, it's a loss, and we hopefully make up the loss with the other spread. That's all. Sometimes people are going to lose money. I tried to do something fancy with it, but I didn't see any better way to do it. It's just a matter of saying hopefully we'll get a nice scrunch down in TLT, and we'll be able to get a buck out of the thing and get out of it. But yeah, generally we're looking to sell it and just salvage some money. That's it. Which portfolio is short ABX 2018 $10 calls? I don't know. I honestly can't go digging around portfolios like this. ABX, well, it ain't that one. What do you even? What do you? How much calls? $10 calls. I assume it would be the long-term portfolio then, because it isn't. I don't think it's certainly not in the short-term portfolio. ABX. But you see how this is not a very productive use of our time to start digging around portfolios to find out where it is. Nope, apparently we don't have those at all. So I don't know if I mentioned them or if they weren't official portfolio plays, but I honestly have no idea where that came from. I don't think it's a bad play. I mean, I certainly think ABX is good for that much money by 2018. 2018 $10 puts $249. So you net into ABX for $750. It's at $11.75 now. That's a great sale. How patient can you be with long-term view is very age-dependent. Well, I guess that's true, Ron. But honestly, it's a different kind. Well, that's why I would not run an aggressive strategy. In other words, if a downturn is going to hurt you, then you should stick to something like the butterfly portfolio, which is almost market-proof. We play with that once a month, and it's steady as a rock. It makes 5% most of the time. Most months makes 5%. So a portfolio like that, if you want a steady income, is the way to go. If you want to take more of a risk, though, then we have the long-term portfolio, which is meant to build into stocks as they go down. But the long-term portfolio has gone up and down 20% in this crisis, but the short-term portfolio has hedged it, so we've never really lost a lot of money. You have to just design your strategy for what you're, for what you are. Of course, if you're 95 years old and you don't think you're going to make it 2 years to run a long-term portfolio strategy, then okay. But then you should really think about what you're doing with the stock anyways. Like, what is your goal and what are you trying to accomplish? I mean, 2 years is too long term for you to be thinking. Then really you should be thinking more of a wealth transfer strategy where you start establishing accounts for the people you want to leave money to and letting them have the long-term gains instead of paying estate taxes and so on and so forth. You know, I mean, you got to sit down with a financial planner and think about these things. But, you know, you don't need to keep everything in your name all the time. You can set up a trust. You can do all kinds of things that make more sense if you really are that close to, like, you know, checking out. But if you know, if you're going to live for 5 years, then these long-term strategies are ideal for it. Could you explain the concept of decay for options? They decay. There's a premium in an option. If I go to, well, look at the AVX. Let's take that for example. You sell. So in other words, Barrick Gold is now $11.75. You can sell the $10 puts for $2.50. Who are you going to sell it to? You're going to sell it to a guy who, for whatever reason, thinks AVX is going to be below 10. Not just below 10, though, but he thinks it's going to be more than $2.50 below 10 in January of 2018. He essentially thinks they're going to be bankrupt, I guess. You don't think they're going to be bankrupt, so you sell him the premium. Now, his premium is out of the money. It's all premium in those. 100% of the money that you're selling him is premium. That premium has 700 days until it expires. All right? So basically 0.3 cents per day is going to tick off the clock every day that he's not making progress towards his $10 goal. So as long as those things are out of the money, they're going to lose a time premium day by day by day by day. That's the premium you're selling. And it's a fact. And frankly, even if Barrick Gold ends up at $5, he's still going to lose his time premium, and all he'll keep is his position premium. Not premium, his position. All he's going to keep is his position money. So in other words, if AVX drops down to $5, you'll have to pay him back $5. But he still loses his $2.49 premium he paid. He doesn't get $7.50 at $5. He gets $5 at $5. So the premium that he pays you goes in your pocket and stays there, and the only thing you now have is a bet that you're betting that it's above 10. But that $2.50 stays in your pocket, and every single day he loses more and more of the time portion of his thing. That's called theta in options. That's called the theta value. That's the time value in position. And that's the beauty of selling the short put like that and using our strategies, because no matter what happens, time is going to move on and the things are going to lose value. And if you sell puts and calls, now you can't possibly lose on both ends. So what if I sold the $10 puts for $2.50 and I sell the $15 calls for $2.50? Now I'm putting $5 in my pocket, and the only way I lose is if AVX is above 20 or below 5. So I've sold the puts for $2.50, I've sold the calls for $2.50. I have bet this guy that AVX will be under 15. I bet this guy AVX will be over 10. So my sweet spot where I keep the whole $10 is anywhere between 10 and 15, and I don't lose money unless it's over 20 because I have 5 in my pocket. I wouldn't do that because I think we might be over 20, but that's the premise of the bet. What I do feel strongly about, though, is it will be over 10, so I like that end of the bet. And that essentially is what we do with the butterfly portfolio, except we do it shorter term and we've hedged our longs to make sure we don't get burned. If you decay for ETFs, oh, that's a whole different thing. Oh, I'll just explain that. Decay for ETFs is different because there's a fee. In these ETFs, they constantly buy and sell either futures contracts or buy and sell the stocks. And just like you do, if you churn your account, they're churning the account on your behalf. They're constantly buying and selling and getting in and out of things depending on the flow of money into the ETF and out of the ETF. And because of that, there's a constant fee that eats into it. There's a bid and ask spreads that they lose money on, and there's fees that they end up paying when they do these in and out positions, even though they're paying it to themselves, by the way. You've got to watch that. Okay, the guys who run the ETF, they collect the fees for selling all the stocks into the ETF. So they have a different arm of their business that then all they do is make money off the fees for the ETFs that they're charging to you. So they've got a guaranteed winner. Meanwhile, the costs that are incurred by the constant rolling of the ETF eats into the ETF value and over time decays it. You're welcome, Paul. And thanks, Tom. That's very good when people chip in and help with stuff. Okay, cool. Here we are, 2:44, running a little bit late, but all good. Unfortunately, there's nothing very exciting in the markets to trade. Damn it. I've got to get rid of that button. There's nothing exciting in the markets to trade. But we are at the highs, and Europe finished at the high, so you sure as heck can't go short on this market. All right, we're just going to have to wait and see what happens. We're over 1925 right now. That's great. This is our strong bounce line. We hold that strong bounce line and start making progress. We're in recovery mode. This is actually reasons to be bullish. We're over that, 4,200 especially. It's 4,200 on the NAS. It's a nice broad index, although it's run by Apple, but Apple's been beaten up so much it's a good thing to be run by right now. And over 1925, that means we strong bounce. By the way, what's the strong bounce? It means we've retraced 40% of the drop. So the amount we dropped from 2,100, we've now gotten back 40% of that run, which means we're now 60% of the run away from getting back all the way to 2,100. I don't think we're going to get there. We don't deserve it. We don't. There's nothing about earnings and nothing about Fed stimulus or anything else that says we should be back at 2,100. So I think we're going to stall out around here to 1950 is probably going to be the top, and then we're going to come back down a bit and consolidate. That's what I think is going to happen. So we'll check in next week and see if I'm right. But I'm not. I'm into bottom fishing here. There's still plenty of stocks like ABX we just looked at. There's plenty of things that you can sell puts on and still get a phenomenal return. But I'm not really heavily into buying things, especially things that are getting back near the top. Things that are still dead in the water, I like picking them up for recovery because I think we will steadily recover. But I think all year long we're going to be kind of consolidating not too far from where we are now. I think this is basically the right price for the market. And in absence of other stimulus, this is where we're probably going to stay. All right, so have a fantastic week, everyone. Enjoy the trading. Enjoy the market. And we hope you all participate in these great returns. And I'll talk to you next week. Oh, by the way, this weekend, the Money Show is in New York, and I'll be doing a speech on Monday afternoon, I think at 4 o'clock. I'm supposed to be giving a speech on Being the House, on our general Be the House strategy. And I don't think tickets are very expensive for the Money Show. I think it's like $50 or something like that. So if you want to see us live, you can come down there on Monday, and otherwise I'll see you guys again on Wednesday like normal. All right, have a good day, everybody.